Welcome back. Now the trade setup we are going to discuss is known by a couple of different names in different schools of technical analysis. For example, it is called a wedge in classical technical analysis. But within the purview of classical technical analysis theory, this pattern is not covered in as detailed a way as it will be covered by us. Essentially, most books on this topic happens to miss on one or more details that really make this pattern very powerful in real life application. The best description of this pattern we ever came across came through a different school in technical analysis, which is known as Elliott wave theory. This theory is a very powerful theory that requires quite a bit of in-depth study and practice in order to master it. But the pattern we are covering here can be applied even without any specific knowledge related to the Elliott wave theory. In fact, we'll be covering this pattern in such a way that it does not refer to the original theory at all. But we would never want to take away the fact that most details that make this pattern so powerful actually emerge from the Elliott wave theory. So let's get on with the pattern. Now this pattern is called the ending diagonal triangle or a wedge. Now this pattern may be a rising pattern referred to as the rising wedge, or this pattern may be a falling pattern referred to as a falling wedge. The words rising and falling refer to the overall price movement as the pattern develops. So in case of a rising wedge pattern, prices move up as the pattern unfolds, while in the case of a falling wedge, the prices move down as the pattern unfolds. We'll start by explaining the theory with respect to rising wedge, and this theory is applicable as it is for the falling wedge itself, except that the price movement in case of rising wedge is up, and on completion of pattern the prices are expected to move down, while in case of the falling wedge the prices move down as the pattern develops, and on completion of this pattern the prices are expected to move up. Let's start by describing the DNA of the rising wedge pattern. Now this is how a rising wedge pattern looks like. The first thing to notice about this pattern is that it consists of 5 legs that are marked as 1, 2, 3, 4 and 5. So you see that this is the first leg which moves up overall. Then this is the second leg which moves down overall. Then this is the third leg which again moves up overall. Then you have the fourth leg and the fifth leg. Overall, when you see all the 5 legs together, you see that the net price movement is up, hence it is called the rising wedge. Now each of these legs, that is legs 1, 2, 3, 4 and 5, is subdivided into 3 sublegs. So leg 1 consists of 3 sublegs. These sublegs are marked as A, B and C. Similar is the case with leg 2. Again, leg 2 consists of 3 sublegs. These are again marked as A, B and C. And you will see that this is the case for all the 5 legs. That is, all the 5 legs consist of 3 sublegs each, and these sublegs are marked as A, B and C. While this is the ideal price behavior, sometimes when you are practically using this pattern, you may not be able to divide one of these legs into 3 sublegs A, B, C, which is fine. In real life, what you should see is that most of these legs are clearly subdivided into 3 sublegs. However, if one or two legs have worked out in such a way that you cannot divide them into 3 sublegs, you can still look at the other characteristics associated with the pattern and move ahead to successfully identify this pattern. The next thing to note is that how we have joined the points where the leg 1 and leg 3 end to form a trend line. Similarly, we have joined the points where leg 2 and leg 4 end to form another trend line. Let's call the trend line obtained from joining ends of leg 1 and leg 3 as T1, and let's call the trend line obtained from joining ends of leg 2 and leg 4 as T2. You will see how T1 and T2 converge towards each other. This is another defining characteristic of this pattern. The price action is moving up in this case, but at the same time the price action is converging, because of which these two lines are converging. It is very important that lines T1 and T2 converge towards each other. If you are tracking a pattern in which lines T1 and T2 are not converging, then it is definitely not a wedge or an ending diagonal pattern. Now another characteristic that defines the DNA of this pattern is the price action around end of the last or the fifth leg. Here, very often it is found that the price briefly moves up the trend line joining the points 1 and 3, that is the T1 trend line, and then quite quickly the prices reverse to come back and close below this line. This action is known as throwover action, and it happens often in this pattern, but it is not necessary that this price action at the end of the fifth leg might happen. But in cases where this throwover action actually occurs, it becomes much more easy to identify this pattern, which makes it easy to enter into your trades quickly. Now, opposite of this rising wedge or the rising ending diagonal pattern is the falling wedge or the falling ending diagonal pattern. This pattern is shown here. As you can see, this is just the inverted version of the rising wedge pattern, but the essential DNA of the pattern is the same. This is so because the only difference between the rising and the falling wedge is that one appears in an uptrend and the other appears in a downtrend. So again, here you see that the pattern is broadly divided into 5 legs. So you have the leg 1 which moves down, then you have the leg 2 which overall moves up, then the leg 3 which overall moves down, and so on for leg 4 and leg 5. If you look at the price action by combining all these 5 legs, then the net movement is down, which is why this is called as a falling wedge. Now each of these legs is further broken down into 3 legs each. So you see how leg 1 is broken into 3 sub-legs marked as A, B and C. Same is the case with leg 2 and all other sub-legs. Also, you notice how trend lines T1 and T2 converge towards each other, indicating a converging price action. If these trend lines are not converging, then it is not a wedge or an ending diagonal pattern in action. Finally, in this case also, it is often found that a throwover price action develops near end of leg 5, where the prices briefly and often violently fall below the trend line T1 and then sharply reverse to close above the trend line T1, thus indicating that the throwover action is complete. Now that we have understood the DNA of this pattern, let's look at the confirmation signals for this pattern. The single most definitive confirmation signal for this pattern is when the prices reverse after leg 5 ends and start moving in the opposite direction and ultimately close above the line T2. So when the prices cross T2, this pattern is confirmed, and now you can determine what are the various parameters of your trading strategy associated with this pattern. If you remember, we outlined 3 parameters that would determine your trading strategy. First is the trigger price. For this pattern, the trigger price is the price at the time the prices cross the line T2. This is where you initiate your trade, and this should be your conservative entry point. The second parameter in your trading strategy is your exit price or the stop loss price, which is the price where you know that the pattern is not working for you, and so you book your loss and exit your trade. This point happens to be the end of leg 5. So your stop loss should be just below the price at which the leg 5 ends. Now by subtracting your stop loss price from your entry price, you can determine the risk and the potential loss in the trade if the trade goes against you. The third and the final parameter in your trading strategy is your target price or the profit booking price, that is the price at which you book profits if the trade works in your favor. The target price for a profitable trade in this pattern is actually the start of leg 1. So this is the area you should be targeting if the trade works in your favor. Now by subtracting your entry price from your profit booking price, you can determine the reward or the potential profit in the trade if the trade goes in your favor. Now by dividing your potential profit by the potential loss, you can arrive at your reward to risk ratio and take a decision whether or not you should initiate your trade. If you initiate your trade, then you can place a stop loss order and a take profit order and sit back and wait for the markets to do their action until either your profit booking levels are reached or your exit price or your stop loss is hit. It is essentially that simple. Now we can understand if you do not believe that this can work. So let us next show you some very recent examples of actual trades that worked using this pattern. Now in the coming lectures, we are going to take you through examples in different asset classes to see how universally valid this pattern actually is. See you in the next lecture.